What to watch in inflation and Berkshire Hathaway's earnings. Last week, the July jobs report was hard to fault on any measures. The U.S. added 943,000 to non-farm payrolls, which was better than expected, and the previous month's tally was revised higher. While economic output has exceeded the pre-pandemic peak, payrolls have reclaimed almost 75% of the jobs lost to lockdowns in 2020. As expected, service jobs were a significant boost to the job gains this month, with leisure and hospitality the largest share at 380,000. The release also featured a rise in hours worked and hourly earnings, which bodes well for additional hiring activity. Lastly, the unemployment rate fell to 5.4% from 5.9% last month and the COVID high of 14.8%. The yield curve, which has accurately predicted most recessions when the yield on the 10-year U.S. Treasury has fallen below the 2-year, also liked the jobs report. The difference in these yields fell to a low of 0.96% during the week but rose to 1.08% on Friday. This curve steepening gave a significant boost to bank and value stocks on Friday. The U.S. 3-month Treasury yield 18 months forward continues to indicate just one rate hike over the next year and a half. With 6 speeches from Federal Reserve officials scheduled for this week, the mantra of substantial further progress before tapering is likely to be heard. Unofficial tapering, the reduction in asset purchases, announcement from the Fed should not be expected before the tail end of the third quarter. The highlight of a thin slate of releases this week will be the July consumer inflation, CPI, readings. July CPI should show some headline improvement on the year-over-year rate with some relief in the supply chain impacted segments. The focus will likely turn to the rate of increase in the more structural components of the inflation report as the noise from the pandemic impacts begins to dissipate. The various Federal Reserve banks produce several measures of the underlying trend of inflation. The Atlanta Fed's sticky CPI did an excellent job of indicating the stickiness of inflation in the 1970s and our period of disinflation since. This measure is a weighted basket of items that change price relatively slowly. While this indicator has turned higher through June, it has not reached a troubling level. The key will be how much inflation becomes more permanent. The second quarter S&P 500 earnings season slows down this week, with only 12 companies scheduled to report. According to FactSet, 89% of companies have reported earnings so far, with a record high 87% exceeding earnings and sales estimates. Second quarter blended, combining actual and estimated, earnings estimates reflect robust growth at 88.8% year-over-year versus plus 63.3% at the start of earnings season. Berkshire Hathaway, (A/B), reported quarterly earnings on Saturday and are worth reading even if you do not own the stock because Berkshire can provide a broad look at the economic rebound from COVID-19 due to its many operating businesses. In addition, it is managed by 2 of the greatest investors and capital allocators of all time. Berkshire's operating earnings, which removes the distortion from market changes and better reflect the firm's earnings power, for the quarter rose by 21% versus 2020. Notably, the operating income is 9% above pre-pandemic levels. Other than an aerospace business and investment income, Berkshire's earnings have been boosted by the return of robust consumer and housing demand. As seen in many company earnings releases this quarter, Berkshire highlighted some pressure from significant cost increases and supply chain disruptions. A more detailed analysis of the earnings report is here.